Welcome to the Turnaround Take. I'm Joe Sarachek, and today we're talking with Ed Schaffer, an experienced turnaround manager, about software companies in distress. Over the past year, the debate in the financial markets has centered on AI itself, whether it was a bubble, but now software companies are falling sharply as AI adoption accelerates. Ed's argument is AI isn't replacing software, it's reshaping how software is valued, how it's financed, and who survives. So, what does this mean for investors, credit markets, and the future of the SaaS model? Ed, what exactly is AI breaking in the traditional software model that investors misunderstood?
Thanks, Joe. Well, first, pleasure to be here and appreciate the opportunity. If I had known you were going to wear a Yankees hat, we might be having a different discussion being, born and bred in Philly and still very much a Philadelphia fan. But to get to the heart of it, your question, it's interesting. I loved what Bruce Richards said last week in saying that, it's a wrecking ball for valuations. It's not killing software, and I'd love to, take credit for that. I think it's a great term, but you and I talked about that even the week before at the Distressed Investing Conference. It is an impact on valuations, and I think the way I'd want to frame it simplistically is that software has been a hot category for a long time in the private equity market. Especially now with SaaS, you've got strong recurring revenue, you've got great gross margins, a lot of customer stickiness, and obviously minimal, CapEx. A lot of that software, which represents a substantial portion of the PE portfolios these days, was purchased at pretty high valuations. Coming out of the pandemic, those valuations were definitely in the double digits, on ARR and the like, and a lot of those deals were leveraged pretty significantly, anywhere from, I've seen numbers from my own personal experience, sort of on the low end of 40%, loan to value, upwards of 75, 80% in the full on, LBOs. That debt, if you remember, was also really inexpensive at that time. And that is no longer the world that we live in, clearly. When you take that, you look at the fact that we're now, corporate debt is certainly in the world that I'm in, double digits. The so-called add backs on EBITDA are a little bit funny. You're seeing a big change in that whole loan to value equation. And this is all before we even get into the AI impact that's been having. What I think AI has done is, really, it's a threat. It certainly hasn't killed software yet, or isn't going to kill software in the immediate. But it's crashed through the belief that the multiples that those companies were originally purchased at are going to continue. And I think there's really just two fundamental areas that I think you've got an impact on. One is I do think there's a real impact on earnings. Okay. What you're seeing is already a shift in spend within companies from, more seats to let's invest in AI. That inevitably, just, think through the cycle, that's going to affect those very same companies' earnings. It's certainly going to slow their growth rates as more and more people, by the way, myself included, I see this firsthand, are trying to do more with less, and we see AI as a way of getting there. But I think the other side is just a broader, call it behavioral finance fear. The market had a huge overreaction, I think, with Anthropic's recent, release. And, the bottom line is those same multiples we just talked about, which already were starting to become depressed, just further, went through the floor. And now we've got this heightened fear. I love the new term. It's a SaaS-pocalypse. But the one thing that I'll leave you with in this is, right? Where do these terms come from? The patient was already sick. AI has become, the fever, so to speak, that I think has really brought it to the forefront.
You know, it's funny because this morning I was listening to Bloomberg. They were talking about workflow, and they were talking about Salesforce, the price of stock going down. You break software companies into winners, survivors, and vulnerable incumbents. I'm an investor, Ed, coming to you for
Yeah.
advice. Can you tell me how to pick a winner? Because as a distressed investor, I'm always looking for opportunity. How do I pick a winner, Ed?
Well, so I think this is an interesting question. That gets into another part, which is where is kind of the, maybe an opportunity to play in sort of the credit versus equity side of things. But, I want to step back and sort of globally answer the question and then drill into exactly what you're asking, Joe, because, you know, there are a lot of pundits out there that are obviously predicting where AI is going. I have no basis on, standing on that ground as many of the far more skilled and schooled folks who are directly dealing with this in the science side of things. But first of all, some of the things that I've paid attention to are indicative at the larger level that where there was a lot of belief in the evolution of AI getting into full on generalized intelligence, we may start seeing diminished returns. Whether you believe that or not, is up to you. To some extent, some of what I've seen behind it makes some sense. Okay, and that's an important piece because at the end of what I'm building to in the hypothesis is there's still time. The second piece, though, deals specifically with the companies, that are providing software solutions today. I've had some very interesting conversations, even in the last few weeks, about fundamentally what's the liquidation value in today's market of a software company. And arguably, you could make the case that it's zero, right?
Wow.
Because there are no hard assets. Once upon a time, 20 years ago or so, it took months, maybe years to develop a software package. And if there was a liquidation, that was an asset you could sell. That's not the case today. You can develop a software application overnight. And in fact, they're doing that with AI tools. Now, the question though is why is there still going concern value, which I would argue there very much is. And I've had that conversation, including recently with some investment bankers who are in the throes of this in software specifically. And the reason for that going concern value is because the customer relationships are real. The go-to-market ability of a company is a very real thing, and not every company executes it better. And yes, AI on an agentic basis can enable, it can augment it, but it can't replace it, not yet. And I think that that's an important thing to consider. And then secondarily, on the back end in servicing and supporting those customers, be it from the new features that are there, you need to understand what those customer needs are. You need somebody to own that relationship so that they can deliver for the customer. At the end of the day, I think we minimize that, particularly, in the B2B world, which I've long operated in, those the ability for a company to have trust and faith in their vendor that they're going to look after their needs, that they're still going to be there is a critical thing that I don't think the AI providers, which at the moment, the ones providing the solutions are really the big players. We're a long way away from them stepping into that. It's a whole different dynamic, a whole different, operating structure, a whole different, frankly, company that they've got to build. And I just don't see that happening. On the flip
So,
side, on the losers, by the way, um, and this is a broader category, the area that I probably worry the most about are maybe the data provider services. One of the questions that I have, and this is just something I was pondering in some of the last few things that I've attended, if any of those data sources ultimately become public enough, will AI just as easily be able to, replace some of the likes of, a lot of the various research providers that are out there? How big is the moat, as you and I have discussed, for those things specifically? On the, back to the SaaS and software solutions, I think there are opportunities. And now it becomes really, and this is the piece that's different, that as you look at each of these companies, there is going to be a careful evaluation that needs to be made. Does this company make sense to still exist? Is there a short-term play? And even 5 years from now, will this company occupy a category that has not fundamentally changed, and should it? And I think that'll
Ed,
be
this reminds me
incumbent.
of when I first got into the bankruptcy field. My boss used this analogy. Is this company making gas street lamps, which are essentially extinct except in high-end resorts? All streets used to be lit by gas street lamps. So that's kind of like where you're going with this question.
Right.
Is is there a purpose to this company? And I think that's a practical question to ask. Let me ask you this question, Ed. We have this fund, strategic liquidity, we buy intangibles. Do these software companies have intangibles for sale, judgments, class action claims? Not IP, because you're basically saying that in many cases the IP isn't really worth much. Do they have claims like that?
I can't answer that question holistically, Joe, to give you, a clear yes or no. But it is interesting. I've been talking recently to a couple of recent Harvard Law School grads who are developing something interesting, uh, in the software solution standpoint. And we had this very discussion around IP specifically, and I definitely have a strong take on how much is IP protectable. I'm not sure that it is. To your question on these other things, I have not seen that. And I have not seen those claims. Fundamentally, what I think it has, and it's going to be for a very different type of investor, is you've got cash flow. There are real cash flows, and if you can clean the capital structure to where you no longer have all this debt sitting there. Look, I lived through, I was operating at the time of the internet bubble, and when valuations was based on eyeballs, and I didn't get it. I was not caught up in that. Clearly, I wasn't wired for that. I do understand the VC model and grow at any cost. There's a time and a place for that. But as you look at what we're kind of facing now, I think what you're looking at is some companies that really have the ability in today's business models. They're real business models that have real, needs to be met from a customer, whether B2B or consumer, and they can deliver it and they can do so profitably. Is it going to be attractive enough for VCs? No. I mean, we've passed that point, obviously, with some of the things that are going on. Is it going to be attractive for the private equity firms? Sure, if you came in at the right price. Is it attractive for the distressed investor? I think so. Now, can you come in at the right, level, right place? And as you and I have discussed, then it's not so much the claims, you now have an operating entity. It's a different kind of distress situation, no doubt.
Ed, listen, thank you for all your insight and taking the time today to do this interview. Please let my audience know where to reach you.
Sure. Obviously, I'm on LinkedIn, and probably the best way to get me. And I'll be happy to put my contact information in whatever we provide.
As for me, if you're interested in staying in touch on top of all things distressed, please follow me. And thank you, everybody. And go Yankees. Let's make it this the year for number 28. That's 28 world championships, Ed. Thank you.
Thank you, Joe. Appreciate it.